In today's video, I will show you how I used a simple smart money concept setup to target internal liquidity and achieve a clean 1 to 5 risk-to-reward trade. Most traders focus on external liquidity and often miss high-probability opportunities like this. Make sure you watch until the end, because I will also share a mistake that many traders make repeatedly, and improving this one habit can have a significant impact on your trading performance. Before looking for any buying opportunity, the first thing I noticed was the sell-side liquidity resting below these lows. Many traders had their stop losses placed beneath this area, making it an attractive liquidity pool for smart money. Price then moved lower and swept that liquidity, triggering those stops and creating the fuel needed for a potential reversal. This is why I always pay attention to liquidity first, because understanding where liquidity is resting helps explain why price moves from one area to another. In this case, the sell-side liquidity sweep became the first clue that a bullish move could develop. After the sell-side liquidity was taken, the market began showing signs of strength. Instead of continuing lower, price reacted aggressively to the upside and broke above the previous swing high, creating a bullish break of structure. This was a very important moment because it confirmed that the market had shifted from a bearish environment to a bullish one. Many traders make the mistake of entering immediately after a liquidity sweep, but I prefer to wait for a break of structure because it provides additional confirmation. Once this bullish break of structure was formed, I had a clear reason to start looking for buying opportunities instead of trying to sell the market. At this stage, the market began creating inducement. After the bullish break of structure, price started pulling back and formed a temporary low, encouraging traders to enter the market too early. Many traders saw the bullish momentum and rushed into buy positions without waiting for price to reach a key area of interest. This is exactly how inducement works. The market creates an attractive setup that draws participants in while building liquidity below the pullback low. Instead of chasing the move, I remained patient because I wanted price to return to a more favorable location before considering an entry. The area that caught my attention next was this bullish order block. This order block was formed by the last bearish candle before the strong bullish displacement that created the break of structure. The reason this zone is important is because it represents an area where institutions may have placed significant buy orders before driving price higher. Rather than entering randomly, I wanted price to return to this area and show a reaction. By identifying the order block after the break of structure and inducement, I was able to build a stronger trade idea based on both market structure and liquidity, rather than relying on a single concept alone. When price finally returned to the bullish order block, I still did not enter immediately. My goal was to see whether buyers would actually defend the zone. As price tapped into the order block, the market failed to continue lower and began showing a strong bullish reaction. The rejection from the zone was followed by bullish candles closing higher, which confirmed that buyers were stepping back into the market. At this point, the setup had all the elements I look for: a sell-side liquidity sweep, a bullish break of structure, inducement, and a confirmed reaction from the order block. With multiple confirmations aligned, I executed my buy position and placed my stop loss below the order block to maintain a controlled level of risk. Instead of targeting external liquidity, my focus was on the internal buy-side liquidity, resting above this area. This is where many traders have a different approach. They often hold their positions, hoping the market will reach a much larger target, but that can sometimes reduce the probability of the trade playing out successfully. In this setup, the nearest internal liquidity offered a clean and realistic objective, while still providing an excellent 1 to 5 risk-to-reward ratio. Once I identified that liquidity pool, my trade plan became very straightforward. I only needed price to move from the order block into the internal liquidity target. By focusing on a high probability target, rather than a distant one, I was able to secure a strong risk-to-reward opportunity without relying on the market to make an extended move. At this point, some traders might wonder why I did not target the liquidity resting much higher in the market. The reason is that my objective is not to capture every possible move. My objective is to focus on the liquidity that has the highest probability of being reached. In this setup, the internal buy-side liquidity offered a realistic target while still providing a strong 1-to-5 risk-to-reward ratio. Rather than chasing a larger move and exposing myself to unnecessary uncertainty, I preferred taking the high probability liquidity that the market was most likely to deliver. Before ending the video, I want to talk about a few mistakes that I see many traders making repeatedly. The first mistake is chasing external liquidity on every trade. Many traders identify a good setup, but instead of taking a realistic target, they keep extending their take profit and eventually watch the market reverse before reaching their objective. There is nothing wrong with targeting external liquidity, but not every trade needs to reach it. Sometimes the highest probability target is the nearest internal liquidity. Another common mistake is entering a trade without waiting for confirmation. Traders often see an order block and enter immediately as soon as price touches the zone. The problem is that not every order block will hold. Waiting for confirmation can help you avoid unnecessary losses and improve the overall quality of your entries. A third mistake is focusing only on win rate. Many traders want to win every trade, but professional trading is not about winning every time. It is about managing risk and allowing your winners to outweigh your losses. A single, well-executed trade with a strong risk-to-reward ratio can make a significant difference over time. Finally, many traders learn concepts such as order blocks and market structure, but completely ignore liquidity. Liquidity is often the reason price moves from one area to another. When you understand where liquidity is resting, market movements begin to make much more sense. If you can improve these habits and remain patient for high-quality setups, your trading decisions can become far more consistent over the long term. That concludes today's analysis. As you can see, this trade was not about predicting the entire market move. It was about following a clear process, identifying liquidity, waiting for a break of structure, finding the order block, waiting for confirmation, and targeting high-probability internal liquidity. If you found value in this breakdown, make sure to apply these concepts on your own charts and focus on consistency rather than perfection. Thank you for watching, and I will see you in the next video.